Hello, I'm David Cassidy with the market update today, Thursday, the 2nd of April. We mentioned yesterday April has started in a similar way to those horrible March days, as the Dow Jones had another near 1,000-point down day, falling 4.44% after officials said the USA could see as many as 240,000 coronavirus deaths. Unfortunately, as we've said before in our daily updates, the current situation is unprecedented, and as such, only one thing is currently for sure. Volatility is never more than a headline away, and as a consequence, it seems volatility is for now the new normal. However, we believe these large swings are irrational and simply emotionally driven. And while we fully appreciate that they're unnerving, it is very important to maintain a long-term perspective and resist the urge for any knee-jerk reactions. Equity markets hate uncertainty, and the coronavirus outbreak is a big uncertainty. The coronavirus outbreak will subside, and the stimulus measures that the government and central banks have provided and are likely to increase further will allow confidence to return and equity markets to recover. It hasn't just been global equity markets, however, that have been volatile. Oil markets have been as well. Following a breakdown in talks between OPEC, the Organization of Petroleum Exporting Countries, and Russia over production cuts during March, Saudi Arabia started what is seen as an oil price war with Russia, as they announced that they would significantly increase production in order to increase their share of the market. However, in reality, it may be that both Saudi Arabia and Russia want to eliminate US shale producers. Saudi Arabia is the main influencer of OPEC and was, until about 5 years ago, the main swing producer and price manager, and as such would historically scale back production when prices fell and increase output when prices rose. However, this role was effectively surrendered back in 2014 due to the US shale revolution, as the extent and spread of the US resurgence in oil surprised and weakened the traditional cartel. By flooding the market with oil at a time when demand is rapidly diminishing, Saudi Arabia has pushed the barrel of Brent down from roughly $70 in January to just a fraction over $20 a barrel yesterday. However, today the oil price has jumped over 10% after China said it would buy oil to bolster its strategic reserves. Now, although a 10% move may sound large, it's actually immaterial given that it is still a long way down from where it started the year. And with Florida and Pennsylvania joining the list of states ordering people to stay at home, the supply glut, and as a result, low oil prices, are, in our opinion, here to stay for the foreseeable future. In normal circumstances, we would all be jumping for joy, as we would view this collapse as a positive, given it is the equivalent of a massive tax cut for users. For example, global oil consumption is normally approximately 100 barrels a day, and as the cost of a barrel of Brent has declined by nearly $50 a barrel since the start of the year, this would, in normal circumstances, roughly equate to $5 billion of stimulus per day, which is a massive $1.8 trillion per year. Unfortunately, it isn't currently helping, as demand has dropped well below the normal 100 million barrels per day, as we are all unable to take advantage of it given the lockdown restrictions.